This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello, we thought we would do an emergency introduction to this week's AJ Bell Money and Markets podcast because it is Thursday lunchtime and we have just had an update from the Bank of England, which has voted 7-2 to cut interest rates from 4.75% to 4.5%. Now, what was really interesting was the vote split. 7 voted for a 0.25 percentage point cut, but 2 voted for a 0.5 percentage point cut. And that has changed market expectation of where markets expect rates to go by this time next year. Most now pricing in at least 1% of further interest rate cuts over the course of the year. And that changes things considerably. Another thing which the bank said was that it now expects growth to be looking pretty sluggish for the full year. So back in November, growth expectations, 1.5% GDP increase, now just 0.75%. Plus, it is thinking that inflation will go back up because of higher energy prices to about 3.7% towards the back end of the year. So a really tricky balancing act for the Bank of England because, of course, 2% inflation is the target, 3.7% nowhere near. But concerns about stagflation, a stagnant economy with inflation going up, is something which is troubling the Bank of England at the moment. They seem to be prioritising growth over inflation. And if inflation does stay around that 3.7%, then it looks like the bank will be able to keep cutting interest rates as it tries to stimulate economic growth at the same time. One thing that was mentioned, of course, everyone's talking about it at the moment, tariffs, the potential impact of Donald Trump on the global economy. That's something we just can't factor in at the moment. Markets have tried, but clearly at the moment it is impossible to figure out where Donald Trump is going to go. But this lunchtime, the pound is down against the dollar and the FTSE 100 is going great guns because of the expectation that all those companies that earn in dollars will have a much better exchange rate when they come to get their cash changed into pounds. So that is where we are with the Bank of England. Now it is time for the regular episode of the Money and Markets podcast.
Hi, you're listening to the AJ Bell Money and Markets podcast. My name is Dan Coatsworth, and you're in the right place if you want to know what's going on in the world of investing in personal finance. Joining me this week is Danni Hewson. Hi there, Danni.
Hi, Dan. I think it's fair to say that tariffs have been on everyone's minds this week, and they've caused some big movements on the markets and dominated the discussion for many big companies. We're going to run through the key points and how they relate to investors.
Now, a government consultation on lifetime ISAs closed this week, so we thought it was worth chatting about the pros and cons of the account and the changes that we hope to see in the near future.
The team from Shares Magazine join us to talk about Diageo's results, and we'll also be talking about the latest numbers from Alphabet, GSK, Estee Lauder, Mattel and Disney.
AJ Bell's very own Rachel Vahey will be here to talk about new figures on changes to the UK population and how this actually links to pensions.
And we'll also be chatting about how certain activist investors are getting what they want.
I think we should start with the market tantrum about tariffs. That definitely is the big story. So, Danni, I knew, we knew the tariffs were coming. I was just wondering, why do you reckon that markets had a real wobble then? Because it's not like it was a surprise.
It's not like it was a surprise. And if you look back, they had a wobble back in November when Donald Trump got in, when he was, making all that noise about tariffs. And he had said when he set foot in the Oval Office that tariffs were on the way. We knew 25% Mexico, Canada, 10% China. We knew when they were due to come in. But I think, honestly, markets were expecting that this would be just a bargaining tool. And as we hit Monday, and the realization dawned that actually these tariffs on Mexico and Canada were coming in and you're hearing all this talk about retaliation from Mexico and Canada, investors got completely spooked. And we did see some major market movements. I mean, Asian markets tumbled. A lot of papers were dubbing it Manic Monday. So the Nikkei 225 was down more than 2%. We saw the FTSE 100 drop 1.3% in early trading. In fact, at one point, there were only 4 stocks in positive territory. And I know you sent out a note saying that it summed up the mood perfectly. It was a can of Coke, a smoke, and a headache tablet, because it was just Coca-Cola, Haleon, and 2 UK-listed tobacco companies that were in the green. But, everything looked really glum. What was interesting is that Chinese markets were not operating because it was Lunar New Year, so we're only really sort of able to see it through the lens of the Japanese market and the Australian market. But European markets clearly had jitters, because alongside this threat of tariffs coming in on Canada and Mexico, you had all this talk from Donald Trump about, Europe needs to look out. I'm going to be talking to them, but, maybe the UK will get away with it. We had, obviously, Wall Street opening, and Wall Street opened down. And then, as is Donald Trump's wont, suddenly it came in the news that Mexico had reached some kind of agreement with the US administration, and that tariffs there would be suspended for a month. We saw European markets start to pick up, and it wasn't long after that we heard that Canada's tariffs would also be suspended for a month. It has been really interesting because, as you say, why did markets react the way they did when we knew that they were coming? And I think it's the volatility, the uncertainty, and the maverick that is Donald Trump that has effectively got markets get their knickers in a twist, because people just thought it's not going to happen. And then, oh my gosh, it is going to happen. We've got to deal with it. And then, oh, look, it was that roller coaster ride. It's not actually going to happen. The trade war. Well, is it? Because, of course, then we got China coming back saying that they were going to impose their own tariffs on the United States because that 10% tariff did come in. So, yeah, volatile, definitely. Over, not by a long shot.
Yeah, because there was talk that Donald Trump was going to have a meeting with the Chinese, prime minister, and it's sort of, and then within hours it was like, no, this meeting is off. Clearly, that's got to be down to the fact that the US just literally just went ahead and imposed these tariffs. There is no sort of compromise. So clearly, to no surprise to anyone, China has now retaliated, declared an antitrust probe into Google. It put Calvin Klein owner PVH and the biotech firm Illumina on what looks like a naughty list, calling these companies unreliable. I guess Trump always likes the last word, so he's tightened the screws further by blocking incoming parcels from China into the US. And so obviously that's not very good for certain e-commerce companies in China, but perhaps good news for US retailers who perhaps been facing some competition. What do you reckon, Danni?
Yeah, there's been a lot of discussion about this so-called de minimis exception, which not only happens in the United States, but also happens here in the UK. And those big Chinese retailers like Shein and Temu, I mean, they have exploited this particular area of legal weakness by sending really low value items direct to the consumer. And I certainly know my house gets an awful lot of those low value parcels. And I know a lot of teenagers in the United States are the same, because this is really low value stuff. And it's often pretty good quality as well. So retailers in the United States have been sort of coming up against a bit of a brick wall here. And it's not something out of the blue, because the Biden administration was looking at this as well. So on top of this 10% tariff that the US imposed on China, Donald Trump signed this executive order effectively eliminating this exceptionalism. And then this morning, we're recording this on Wednesday, we woke up to the news that the US Postal Service had stopped accepting parcels from China and Hong Kong until further notice, which potentially means that, Shein and Temu and those kind of companies are going to think again about how they work. And it is interesting that although we're talking about, this global trade war, and we're talking about it in terms of country against country, it's when you actually drill down and you see the impact of it on individual companies that you sort of get an idea of how it then is going to filter through to individual households. And as you say, Calvin Klein owner PVH is effectively being put on the naughty list along with Illumina. And we've had Google in the spotlight because it is being investigated by China for market regulation, for violating the country's anti-monopoly law. So, they're really hitting these companies where it hurts, because they think that those companies are then going to complain to, the United States, to their elected officials, and that potentially will then put pressure on Donald Trump. But at the same time, we have this huge situation where Donald Trump's getting clearly his ear bent by people like Elon Musk, because Elon Musk stood to lose out from a Canadian deal, which may now be back on the cards. But this, I think, is going to get incredibly messy. And I think that is why, although markets have been a bit more subdued over the last couple of days, maybe sort of looking at the headache and thinking, well, I'm not quite sure how to price in risk, because I'm not sure what the risk is or what the risk will be next week. But it was really interesting because I was looking at gold prices, and today up a further 1%, continuing their record rally, because investors are looking at that as a safe haven when everything else really is shifting about quite a lot.
Yeah, I mean, we are starting to get companies trying to sort of quantify what would happen if tariffs are imposed. I know there's still lots of uncertainty around if they're happening, when they're happening, sort of thing. But Diageo certainly is one that's sort of already come out and said it's had an impact on its planning. So let's bring on Tom Sieber and Ian Conway from Shares Magazine to explain what Diageo's been saying. And also, they're just going to talk a little bit about this financial results from the company, which came out earlier this week.
So drinks company Diageo became one of a number of companies to warn on the impact of tariffs. And notably, in its latest results, it withdrew medium-term guidance. And that's, I guess, Ian, because it imports quite a substantial amount of drinks from Mexico and Canada into the US.
That's certainly a factor, Tom. Yes, obviously with these tariffs on Mexico, you've got its tequila business, so that's going to be at risk slightly. We don't know about what tariffs there might be on the UK and imports of things like scotch or vodka or anything produced here. But yeah, that's certainly a headwind. And it's just in a tough place at the moment. But I think the results were kind of reassuring in as much as, if not volume, then at least price is improved. And so the organic growth was slightly positive, wasn't it?
That's right. Yeah. So just nudged into sort of positive territory in terms of organic sales growth. But yeah, I mean, you make a really good point. I think it's fine that the business has stabilized a little bit, but whenever you remove guidance, the market doesn't like it, for obvious reasons, because it can't, you're basically removing the market's ability to look through and see what the business might be doing in the future. And while that might be sensible, because obviously they've got to assess the impact of tariffs, and obviously as we speak, I should probably clarify that we're speaking on Wednesday at 11:30 because the Trump administration is quite unpredictable. The Mexican and Canadian tariffs have been postponed. So whether or not they'll eventually come in, or, Trump's prepared to just use it as a negotiating position, that's open, to question, I suppose. But yeah, I mean, looking at the results in the rounds, like we said, sort of slight organic growth. And there were some areas of strength. They had some pretty good growth in North America with brands like Don Julio and Crown Royal. Guinness is doing really, really well. So that's striking, and we'll talk about that in a bit, because there's been some speculation about Guinness and whether or not it's got a permanent place in Diageo's portfolio. But other big brands that Diageo owns, likes of Johnny Walker, Smirnoff, Casamigos, Captain Morgan, they didn't do so well. So yeah, it was a mixed bag, but I think the headline was very much the withdrawal of guidance. The background, I suppose, on Diageo, I think, what we saw in response to results was, not a huge sell-off, but the share price did fall to kind of 5-year lows. It's lower than it was, in the immediate aftermath of the pandemic sell-off. So yeah, that's quite striking, and it shows the problems the company's been having. I mean, perhaps Ian, you could talk about
Tom,
that. Go on.
Yeah, well, what I was going to say is, I think, put it in context. The whole drink sector has been under pressure. If you look at Pernod Ricard, you look at Rémy Cointreau, they're the two big European peers, and their shares are at 8-year lows. So it's the whole sector really is under pressure, because you've got these headwinds. We've read a lot about it in the papers about younger people drinking less. You go back 4 or 5 years and consumption was rising quite sharply. And it was one of the reasons to own drink stocks, apart from, obviously, great brands, great pricing power, and so on. It was the fact consumption was going up in the West. That's not the case now. Spirits are less popular. You've also, we've talked about previously the sort of, is this anti-obesity theme sort of having a knock-on effect on other, slightly less healthy consumer brands? Is it affecting, chocolate makers, snack makers, and you can put drinks makers, spirits makers into that as well.
Absolutely, yeah. I mean, I've seen some reporting suggesting that anti-obesity drugs themselves, which obviously we've seen increasing proliferation of, it basically sees people lose their taste for alcohol. So, if those drugs are going to increasingly be used by large swathes of the population, that could have implications. The start of the year, the drink sector got a bit of a jolt as well, because the Surgeon General in the US, or the then Surgeon General in the US, Vivek Murthy, called for cancer warnings on drinks labels. They do something similar in Ireland. It's kind of, I guess, what you see with cigarettes. Whether or not there'd be the same appetite for that kind of quite tight regulation, I suppose you'd call it, under a Trump administration, I guess, is open to question. But the fact that it had been floated, I think, was seen as another risk.
There's a lot. Sorry, I was going to say there's a lot of bad news in the price. Let's say, we talk about 5-year absolute lows. I mean, if you look at it on cyclically adjusted earnings, the stock is as cheap as it was in the financial crisis in 2008, 2009. And you've got to go back before that. You've got to go back to kind of the tech bubble, when drinks companies were the last things that people were interested in. It was unless it was tech, it was just totally out of favor. So yeah, it's at levels where it's recovered before.
Yeah, I mean, one of the brands that perhaps looks like a bit of an outlier is Guinness, which, given that it's predominantly a spirits company, it doesn't necessarily fit. And there has been some talk recently about a potential sale of Guinness. It's fair to say the company's completely dismissed that for now, and there was no mention of anything along those lines in the results. Although I know that they have been doing some things in Africa, which might offer a bit of a clue.
Yeah, it's interesting. I think this chat about selling Guinness, there's probably two themes going on in the background here. One, as you say, in Africa, they've been what we call taking flags off maps. They've been selling their Guinness production facilities in a number of African countries. So, actually it sells well there. Africa is one of its biggest markets, and it always has been.
Yeah.
But you kind of wonder why they are selling the production facilities to local producers, and it's not unthinkable, maybe that it sells it. The other rumor is that they want to buy the 66% of their joint venture with Moet Hennessy, and that's part of LVMH, which is the world's biggest luxury firm, owned by multi-billionaire Bernard Arnault. And actually, it sort of made sense on one hand if they were interested in that business, because this wine and spirits business, again, if you think of the Moet Hennessy, you've got some amazing brands in there. So it would kind of make sense. And they would have to sell Guinness if they were to raise the cash to buy the remainder of that joint venture that they've got with Moet Hennessy. But when you look at LVMH sales for last year, which were released actually just last month, end of last month, the leather and fashion business is going great. Jewelry business is going great. We had Richemont figures recently; they were quite strong. So that the luxury business actually is coming back quite nicely. What wasn't so good was wines and spirits, that very division where sales were down 11%. So you can, I suppose if you're going to buy it when things aren't going well for it, they might get it for a decent price. So maybe they, as you say, the company's denied any plans to sell Guinness, but you could see there might be a strategic rationale because Guinness doesn't really go with the rest of the portfolio, and at the same time, Moet Hennessy doesn't really go with LVMH's main business, which is so much of it now is fashion.
Sure. No, that's a good point. I mean, I think what it comes down to potentially, and as you pointed out, other drinks companies have been struggling as well, but whatever the rights and wrongs of it, Diageo's decline really has taken place under the current CEO, Deborah Crew, who came in sort of quite unfortunate circumstances, obviously untimely passing of her predecessor, Ivan Menezes, who was due to step down sort of shortly after he passed away. But I think, this chatter about potential kind of acquisitions or selling off assets, it's indicative of the fact that she needs to do something. She probably needs to pull a rabbit out of the hat because Diageo is in such a difficult place.
Thanks to Tom Sieber and Ian Conway from Shares magazine. Now let's shift our attention to some personal finance stuff, namely the lifetime ISA, which is under the spotlight. Dan, what's going on?
Well, the government said recently, kind of put an invitation out to the finance industry, say, let us know what you think of this product. Is it still good? Is it working? Is it fit for purpose? Which I thought was quite an interesting move because, clearly the government's got lots of things on its plate. And so, but, you have to welcome it looking at the lifetime ISA because there are a couple of flaws in it. And I really think it's probably worth taking another look. So for those who aren't sure or not quite sure how it works, essentially, if you're aged between 18 and 39, you can open a lifetime ISA. You can put up to £4,000 into it, and the government will give you a bonus of up to 25%. So let's say if you put in £4,000, the government will top that up by another £1,000. It's designed either to help you get on to the property ladder with your first home purchase, or it's designed essentially for later in life. You can take money out if you're either buying your first home at any age or if you're 60. Otherwise, you're subject to a 25% exit penalty. And so here's where the sort of first problems lie. We're now getting stories of people who have saved up for a house purchase. They've worked really hard, squirreling money away each month. They now find that the house that they want to buy is worth more than the maximum £450,000 allowed in the lifetime ISA. So let's say that they found a house and it costing £500,000. Well, what will happen is if they want to get their money that they saved as a deposit, they'll be subject to a 25% exit penalty. The way that works is they'll lose the government bonus, which they originally got, but they'll also lose an extra 6.25% of their contribution. So they are being penalised and losing money for having used the lifetime ISA, and simply because they found a property that's beyond the max that was allowed when the lifetime ISA was first introduced nearly 8 years ago. The problem is that the government hasn't changed the maximum property allowance. But since that lifetime ISA was launched, the average UK property price has increased by 28%. So really, if you think, obviously London is clearly affected here because house prices are worth more there. But if you look at property prices around London, parts of Kent, in Surrey, even into sort of parts of Hampshire, if they're not already going over that £450,000 limit, they soon will be. I'm not talking about fancy houses here. I'm talking about a terraced house or a flat, the typical thing that first-time buyers are looking at. So I think these stories of people being frustrated and being penalised for using this product when they're trying to buy the first home, it's very frustrating. So I'm glad that the government is looking at this. So what we'd like to see within AJ Bell is essentially 4 things. We'd like to see the government reduce that early withdrawal charge from 25% to 20%. So essentially, if you do have to take the money out and you're penalised for doing so, you're only losing the government bonus, not additional part of your own money. I think we think that the age restrictions should be removed, and I think that way it could be marketed as a pension alternative for the self-employed. Definitely want to see that minimum property purchase level increase in line with house price inflation each year. And also, there's a suggestion to think that make the ISA subscription separate for the lifetime ISA to all the other ISAs. Try to simplify it, enhance an understanding, and I think that could lead to higher take up. So I stress here that the lifetime ISA is a good product. It does help people who save for their first home, or particularly saving for retirement, such as the self-employed as well. But it just needs a slight tweak to be sort of updated, and then that would be lovely if we could see that. Yes, please.
I think something that catches a lot of people out is that you can, as a couple or as a couple of friends, you can both have a lifetime ISA. You can both get the cash from the government, save that £4,000 every year in and get the top up. But when it comes to buying a house, you can pool together your lifetime ISAs, but you can't pool together the amount that you can, buy a house for. So you can't say, all right, well, there's 2 of us, so that must mean the house price that we can buy is double, because that's not right. Yeah,
I mean, that is annoying, isn't it? But I guess we'll never have a perfect world here of how to do it. But it's I think if you have a government that is really eager to help people get on the housing ladder, they've got to change it, bring it up, modernize it, and perhaps longer term think of how best they can use this to really just to help people. I think obviously anything to help incentivize people to save for the future has to be encouraged. So let's see what that consultation brings us.
Yes, we'll keep a close eye on that. Thank you, Dan. Look, AJ Bell's head of public policy, Rachel Vahey, is here now to tell us some interesting stats on the UK population and the read across to pensions.
So we've got AJ Bell's head of public policy, Rachel Vahey, is now here to tell us about some interesting new figures on the UK population and whether there's some read across to pensions. So Rachel, you all right?
Yeah, I'm very well, Dan. Hope you are too. Yeah. We've just received some really interesting statistics from the Office of National Statistics, the ONS, and it's about the UK population and their predictions of what's going to happen in the future. So these population changes, these really matter enormously to a country and its prosperity. They've got so many knock-on effects, and that they are the driver really behind many economic factors. So we're talking about because a population will drive employment, productivity, and how much taxes are raised by the country and what goods and services it produces. but it's also the driver for the amount of money a country will spend on its population. For example, for benefits, for education and for healthcare. So these predictions that the ONS come out with, there's lots of people in government who really sit up and take notice when these things are issued. So the latest figures are that the ONS believes and predicts that our UK population is going to increase by 7% over the next 10 years. So that's from about 67.5 million nowadays to 72.5 million in 10 years' time. Now, that's a 7% increase. So it's quite a big increase, but it's not coming from an increase in the amount of the birth rate, the fertility rate. In fact, the amount of births and deaths that they predict over that 10-year period, that they think they're going to be roughly equal. So the increase in the population is going to come from somewhere else, and they think it's going to come from migration, and that 7% is going to be pushed forward from migration.
Is this increase going to be seen across all ages or just a sort of certain age groups?
Well, it's really interesting because I'm obviously entrenched in pensions. So when I was looking at these figures, I was trying to pick out what it meant for certain age groups. And for the number of people over state pension age, the ONS predict that's going to increase by a whopping 14%, from 12 million now to 13.7 million in 2032. So that's, that's double what the overall population is going to increase by, not 7%, but 14%. And I think that's even more amazing when you remember that this takes into account the hike in the state pension age up to age 67 from 2028. And all of this is, I think, behind different age generations just getting older. So we have the baby boomer generation, which was born between 1946 and 1964. And this generation some of that generation is already overstated pension age. But just the tail end of that generation, the ones which were born in the early 60s, those are the ones who are now going to start collecting their state pension. And so the amount of people over state pension age is going to increase a lot. But the amount of people over age 85 is also going to increase. And that's going to go from 1.7 million in 2022. And it's predicted to double to 3.3 million by 2047. So a few more years out, over 20 years, but over the next 20 years, it's predicted to double. So I think that's really significant. And what it means is it just puts a lot of pressure on something called the dependency ratio, which is the number of people who are working and raising taxes. And that's the number of people who are working compared to the number of people who are claiming state benefits for being over a certain age. So you can see that it just puts a lot of pressure on those people who are working to pay and help pay to make sure that people who are later on in life have a secure income coming in. This isn't something that's unique to the UK. I mean, many developed nations are seeing this effect and also struggling with this conundrum. And some of these developed nations have been taking steps to try and increase the fertility rate, so to increase the number of future workers to help that dependency ratio. So some countries like France and Australia and some Scandinavian countries as well, what they've been doing is putting into place policies such as improving childcare and offering tax breaks as well to incentivize people to have more babies. And that, in the short term, that did have an increase. We saw some increases in those countries in the birth rate and had a little blip, and it all went up a little bit. But over the years, it's all come back down again, and the fertility rate is going back down again. So it feels more like a blip rather than a long-term solution. So another policy idea these countries might have is to extend the working life. And for people who are aged over 50, 55, 60, to make sure more of these people are continuing to work. And there's some really good points around that. I mean, our health is so much better, and the productivity from people who are over age 55 is proved to be really, solid, and people in these age brackets are very productive. And there's obviously a lot of experience within these generations. But asking people to work longer doesn't usually go down very well with populations, and it usually is met with some resistance if you want to try and increase the state pension age. So it is really difficult to know what governments can do about this. This is all really to do with making the finances work. And I think in the UK, really what we need is a frank and open conversation about pensioners' income in later life. We have a lot of policy talk and government talk about sticking to the state pension and very much sticking to the triple lock guarantee for increases in the state pension. But really, maybe what we need is a fuller debate about what the state pension should look like, when should it start, how should it increase, how should it be paid. And we just really need to tackle this subject. And it goes wider than state pensions as well. It's to do with private pension adequacy, but it's also to do with things like long-term care as well. So lots of very thorny, very difficult conversations for countries such as the UK to have. But with all, like many things in life, it's probably better just to have these conversations and to start to tackle them rather than just to push them away or kick them into the long grass and then leave it up to future generations to really worry about.
Thanks again to Rachel Vahey. Now, it's been a bumper week for companies reporting, and there were some which really caught our eye, including Google's parent Alphabet, which suffered a big share price slump down. What caused the sell-off?
First miss for revenue expectations since February 2023. Now, Alphabet obviously owns Google, owns things like YouTube. It's one of these magnificent 7 group of companies. Everyone thinks it's flawless, but these results are a reminder that it is still doing well, perhaps just not as well as lots of people thought it might do. Cloud computing is not perhaps growing as much as people want. Clearly, cloud computing is linked to AI, and then people thinking that so many companies around the world are investing in AI, therefore all cloud computing companies and providers must be doing brilliantly. So there is growth there, it's just not as strong as hoped. And the other thing that really sort of worried people is that Alphabet came out and said, we're going to spend $75 billion this year on capital expenditure, i.e. on infrastructure, systems and stuff. Ever since we had China's DeepSeek AI system that came out a week or 2 weeks ago and said it could create an AI sort of chatbot system much cheaper than what people have been used to at the moment, everyone's attentions have shifted to all the other players. And so there's a worry here that Alphabet is committing to spending billions of dollars. Is it a waste of money? Because are there cheaper ways of doing things now? So clearly, those are negatives. In the world of search, we all know that Google has been the place for decades that we've all go to first when we want information. Well, now that we've got ChatGPT, we've got Microsoft Copilot, 2 big rival, essentially search systems, because these are AI chatbots, but they are ways of obtaining information. Google's got some big competitors here. Now, Alphabet has its own sort of version of it called Gemini, but Gemini doesn't really have this advantage for sort of in the way that the Google search bar search engine system has done over the last few decades. So that's troubling people as well. But Alphabet does make some interesting points, saying that it is really moving with the times. It is a trendsetter for search. And so I don't know about you, Danny, but you ever use the sort of the lens system it's got? You can essentially see, if you see a picture, let's say of a celebrity, you think, oh, I quite like what they're wearing. You can just use the Google Lens and it will automatically search into it and tell you the product and where to buy it. Have you seen it? It's absolutely brilliant.
I have not seen it. I've heard about it, but I'm steadfastly avoiding it because I think it will be dangerous.
yeah, you'll be into buying too much all the time. And the other stuff it's done is you can on the screen, just get an Android phone and you could just draw a little circle around a bit of information, and that you will essentially use as a prompt saying you want information on, and this is what you're looking for. I think these are really, this is sort of, if you asked 5 years ago, there wouldn't, the idea of that, if people are like, what, this is like way into the future, but now it's like, this is real, this is you can use this now. So I think to Alphabet's credit, it is trying to keep up with events, but clearly just not exciting enough to keep people on board. Hence, we saw a little wobble in the share price as we're recording this. But there's lots of other companies, aren't there, Danny, reporting this week. What's been catching your eye?
Before I say that, one thing that does catch my eye, and this shows my age, and I'm quite sad, I use my phone to take pictures of plants now and then ask my phone to tell me what kind of plant it is so that I can then get them for the garden. So, that's where I'm at. And it is a generational thing, which is impacting one of the companies I'm about to talk about, because Estee Lauder has been trying to turn the business around now for a while, and it has struggled, to say the very least. And we had an update from it, and I'm going to lump Estee Lauder in with Mattel, not just because Barbie would like to use some of Estee Lauder's products, but because they're both talking about tariffs. So while Estee Lauder's still got this huge job of trying to attract younger users who are using new styles of makeup, new brands that are really good at finding people on social media, have become incredibly agile in a way that Clinique, MAC, Jo Malone, all of those brands that come under the Estee Lauder umbrella have just really failed to do. And while Estee Lauder was going great guns in China, there wasn't much of an issue. But we've seen the Chinese consumer pulling back because, first of all, we've seen weakness in China's economic growth, but also because Chinese consumers are sort of looking now towards their own brands. And that is then impacting sales of a lot of Western companies. What Estee Lauder has said in the last couple of days, and we saw the share price fall again significantly, they said that these cost cutting that they're planning at the moment, which includes job cuts, is going to have to speed up. So more than double the number of cuts expected. And that is because of the uncertainty about tariffs. Now, you've got to think that Estee Lauder, like many global businesses, source ingredients for their products from right around the world. So first of all, they've got to think about how tariffs impact that. And then they have factories in the UK, Canada, China, and two of those names have got to jump out at you because we've been talking about them already in terms of tariffs. Now, that's the impact on the company and potentially then the impact on the consumer. Mattel, responsible for Barbies and for Hot Wheels, a massive US loved company, has also said that the US consumer is likely to see the cost of goods on shelves go up because of tariffs. This is a clear indication that all the talk that tariffs will be inflationary for the United States are likely to be accurate. Now, how it all pans out, whether or not overall it's inflationary, I think is way too early to say. And there are a lot of different voices suggesting lots of different potential outcomes. But certainly at a time when we're seeing Mattel doing really well in terms of profits, even though they had slow sales last year, they are expecting recovery this year. The fact that they are warning that price hikes will have to come through to the consumer if this tariff situation gets even more sticky than it already looks, well, I think that just sets some alarms going in some US households.
Yeah, I mean, Obviously, on the subject of Barbie, a year ago, really big name at the box office. Disney has kind of snatched Barbie's crown here, or tiara, or whatever the lingo is. The Disney's just reported its earnings, just as we're recording this podcast. Beat earnings forecast for seventh quarter in a row. Shares are moved higher off this. Now the big driver here was the cinema. I think it was quite glad it didn't have to go up against Barbie. So it got the top 3 films in 2024, which was Inside Out 2, Deadpool and Wolverine, and Moana 2. Now, the quarter it's just reported had Moana 2 in it released, and so it's been a huge success. Really important here is it's got people back in the cinema. A lot of the people sort of said, well, I was kind of happy to watch stuff now on streaming, but this has shown that people still got an appetite to get in the cinema. It's also shown that Disney's not lost its way with creating these really big popular films, because I think there was a suggestion that all it was doing was just getting all the old intellectual property and just rehashing it, remaking films it's already got. At least these ones this year, they're all sequels. I know they're all the sort of same IP, but it's pretty good. And of course, it has these huge box office successes. Everyone's talking about it. And then, of course, when they come on to the Disney Plus streaming platform, if you're not a subscriber, they're great reasons for people, to try and attract, get those subscriber numbers up again. So all in all, Disney is sitting pretty happy at the moment. The only thing in its results which wasn't very good was US theme parks, and that was disrupted by hurricanes. But I think we can cut the company a bit of slack here. I think just while we're talking companies, just got one more thing. I think Danni, I know you want to talk about GSK. That had a pretty positive reaction to its update, didn't it?
It did, absolutely. And I was just taking a look at the FTSE 100 as we're recording this 10 to 3 on a Wednesday, and it's still sitting pretty at the top of the FTSE 100 leaderboard. FTSE 100 actually in positive territory after what's been a tricky few days. I mean, last week, it was a stellar run for the FTSE 100, but it has struggled. So it will be enjoying the fact that GSK has really given it a boost. And again, it is outlook. That has been the big driver of investor interest today. So, Q4 earnings beat expectation. Well, that's great. But of course, with drug companies in particular, with pharmaceutical companies, people are looking at the pipeline. They want to know not what is happening today, but what is going to happen in 5 years' time. And this is where GSK has been an absolute master today, because it's been looking ahead and now says that it expects sales in 2031 to hit £40 billion. Now, that's up from 38 billion that it had previously said. And total sales last year were just over 31.4 billion. So, this is a company doing great guns. It announced a couple of weeks ago that it was investing £50 million over 3 years in a deal with Oxford University. So it's looking at creating jabs which can help prevent some kinds of cancer. So real, speciality stuff, which potentially has money-making potential, a lot of money-making potential for people looking to invest in companies which are doing great things for humanity. Then obviously that is another thing which some people are looking for when they're thinking about ESG. But as you were saying with Disney, there's always a negative in these results. And there was a negative in GSK's results because profits were down significantly over the last year. However, that related to a one-off charge of £1.8 billion relating to the settlement of the Zantac litigation. So just overall, we've seen that investors really pleased with how GSK are performing and what GSK are looking at performing like over the next few years.
Thanks, Danni. I'm trying to book a guest for the podcast to talk about some of these really big pharmaceutical companies, because I think there's a really interesting stuff going on there. So fingers crossed we'll get someone in the coming weeks to talk about that sector.
Now, before we finish, there is time for one more segment, and it is a different take on activist investors, Dan.
Yeah. So obviously on the podcast, if you're a regular listener, we've been talking about some activist investors in the investment trust space, namely Sieber. Now, we're not going to rehash that story again. We've covered that in a lot of detail. What I thought was worth pointing out is while Sieber so far has been defeated on its efforts to take over the management of investment trusts, there's been a handful of investors, activist investors, I should say, in other areas of the market who are winning. Now, this is, to me, it's really interesting. So I'll give you a couple of examples. The first is YouGov. I think lots of people will know them for political polling. They're much more these days than that. There's a company called Gatemore, took a stake in YouGov last year, demanded that the business be put up for sale. And then at the start of this year, wrote an open letter saying, really need to have someone else running this company. The share price has been miserable. It accused them of making failures with budgeting, mishandling communication, having really volatile financial guidance, lack of strategic clarity and stuff. So, it was fairly blunt in saying in the current CEO's first 18 months, they've been a disaster. Think that the market doesn't have any faith. So what it recommended was get rid of the CEO, bring back the guy who used to run the business. This week, that's exactly what's happened. And so essentially, this is Gatemore saying, we've struck gold, we've got victory here. What's going to happen next? So obviously, you've got the former boss. Typically, you wouldn't see them hang around permanently. I think they've been brought in to steady the ship. So I guess the next thing that we need to look out for is when will YouGov officially put itself up for sale? So definitely one to think about. And then we had Engine Capital had a stake in Smiths Group, the big sort of engineering, medical, whatever it does these days, it constantly seems to be changing, but it's a conglomerate, it's sort of industrial conglomerate, it's the best way to do it. Start of this year, it also published an open letter saying time for the board to think about some alternative ways step forward, maximize some value for shareholders, and said the option one was to put the company up for sale, sell it in whole or in pieces, or spin off its John Crane business or sell some of the other businesses. So, it's quite interesting. I think when an activist investor publishes an open letter, it's kind of like a sign that they're just lost patience. And the only way to get change is to go public, put the real pressure on the board to do something else. And lo and behold, Smiths Group has come out this week and said, okay, this is now what we're going to do. Divest the interconnect business. We're going to separate either for a demerger or a sale of the detection business. And then we're just focused on the sort of what they call a world-class John Crane and Flex Tech businesses. So naturally, the share price went bananas on this news, exactly what this Engine Capital wants to achieve. Engine was being successful last year with the pub and company C&C, which also owns Magnum Cider. They were pushing for change, and they've got some CEO come in. And again, that's one where it seems to be the direction of travel is to get someone else to steady the ship, and then will it be put up for sale? So whilst all the headlines all about Sieber being defeated, you can see a growing number of other activists being successful and essentially putting a bit of life back into the share price here.
It's interesting when you get to sort of have a glimpse behind the curtain. You've got to wonder how much pressure is being exerted behind the scenes on all these different companies. That is all we've got time for this week. Don't miss next week's podcast. Dan's going to be talking to the boss of estate agent Foxtons about what he's seeing on the property market. Until then, don't forget to leave us a review of the podcast if you haven't done so already. And thanks very much for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.